Hi traders! Before we delve into the main topic for this video, it's worth remembering that those who watch our YouTube videos and read our related Telegram posts benefit from an advanced heads up in terms of how the market will play out. Let's take a look at the H1 chart up on the screen here for this past Tuesday, when we cautioned traders through a Telegram post to be wary of an upcoming speech by Powell that was misleadingly designated as medium impact on the economic calendar. The aforementioned Telegram post explained why we were likely to see a volatile manipulation play off that speech, and that's exactly what happened. During this consolidation period here, where many FOMO buy traders got trapped expecting another push up, we posted another cautionary note on our Telegram channel, mentioning signs of weakness and the different nature of an aggressive breakout to the downside compared to another push up. And as you can see, we got a brutal correction to the downside. Let's now discuss a trade idea that we here at GFX call the dump and hope trade. We are going to focus on buy examples, but note that the same principles apply for an equivalent sell trade. Going back to the chart, retail traders clamored with excitement to open dump and hope buy positions around these three levels. The three key characteristics of the dump and hope trade are the following. Firstly, traders who open such positions have based their trade idea on nothing other than having observed preceding price action in which price was taken back up quickly and aggressively after relatively deep pullbacks, and thus they expect this pattern to continue indefinitely. Secondly, traders who open such positions do not place a stop loss for the position. When the trade quickly goes into drawdown, they become increasingly averse to manually closing out the position the further the position goes into drawdown. Thirdly, retail day traders make a fundamental tactical mistake with regard to trading like swing traders when they are in fact day traders. Tactically, the latter mistake is fatal, as swing traders can afford to ride out the drawdown, both in terms of time and free margin, until price hits a floor to resume a trending, longer-term move higher, whereas retail day traders have to contend with accruing swaps, and the inability to trade further when their free margin becomes increasingly thinner as price continues to fall. Dump and hope traders fall into a psychological trap that is encapsulated by a term that forensic accountants sometimes use when auditing individuals and companies, namely the conduct of business based on hope rather than expectation. The dump and hope trade for a buy position is based on hope because traders think that given the ongoing primary secular bull trend and the geopolitical backdrop, gold has at some point got to go back up and revisit the all-time high. In expectation of positions opened around the aforementioned three levels, going back into profit for day trading, timescales, however, would have required a pre-planned analysis of, let's say, for example, manipulation, pivot levels, footprint charts, manipulation plays, and crucially, a stop loss for when the timeline for a buyback runs out and a cascading effect for sells starts to take place. The dump and hope trade is disastrous for retail traders because it reinforces bad trading behavior. Professional traders always open trade positions after detailed chart and market background analysis and place a stop loss that they stick to. Please let us know in the comments section if you have been caught out with dump and hope trades, and do hit that like button. Until next time, take care.